Imagine spending 4 straight years working 18-hour days, pouring every single dollar of your savings into turning a concrete shell of a building into a thriving neighborhood business. Then, with zero warning, your landlord hands you a 40% rent hike and smugly says, "That is just the current market rate." You now have an 8-week countdown timer. 8 weeks to figure out if you agree to work for free, destroy your business by relocating, or close the doors forever. Welcome back to Profit Path Analysis. Today, we are opening up the financial books on one of the most predatory traps in small business, the commercial lease trap. We are going to walk through the exact numbers, analyze why landlords hold all the power, and lay out the survival blueprint that every business owner must know before signing a lease. This story comes directly from a real business owner on Reddit who is facing a complete financial disaster. 4 years ago, this founder found an empty retail space on a quiet street. The area was dead, foot traffic was non-existent, and the building was completely bare. Using their own hands, their own sweat equity, and over $50,000 of personal debt, they built out the entire interior. New plumbing, high-end lighting, custom counter space, and branding. Fast forward 4 years, and the spot is a massive success. It brought foot traffic to the block, boosted local commerce, and made the whole street desirable. And how did the landlord celebrate this success? By punishing the founder with a 40% rent increase. They used the foot traffic created by the business owner as justification to squeeze them for nearly half their net income. To understand why this situation is so dangerous, we have to look at the structural power imbalance built into commercial real estate. When you rent a house, you can pack up your furniture and move in a weekend. But when you operate a physical business, your location is tied directly to your enterprise value. Commercial property leases operate on what is known as tenant improvements. Every custom fixture, electrical upgrade, and built-in counter you pay for legally becomes the landlord's property the moment it is installed. If you leave, you cannot strip out the drywall or take the tile floor with you. You leave behind tens of thousands of dollars in asset value. Landlords know this. They calculate your rent increase based on how much money it would cost you to leave. They hold your own build-out hostage as leverage. Let's stop guessing and look at the real unit economics behind a typical small business pulling in $30,000 a month in revenue. Before the rent increase, the monthly operating expenses look like this. Cost of goods sold, like ingredients and packaging, eats up 30%, or $9,000. Payroll and labor costs take 35%, which comes out to $10,500. Utilities, insurance, and merchant processing swallow another 10%, or $3,000. The original rent was $4,000 a month, representing roughly 13.3% of total gross revenue. After all bills were paid, the business generated a healthy net profit margin of roughly 15%. That gave the owner $4,500 a month in net personal pay. Now, let's inject the landlord's 40% rent hike into this exact ledger and watch how fast the business crumbles. A 40% increase bumps the monthly rent from $4,000 straight up to $5,600. That is an extra $1,600 every single month in fixed costs. Here is the fatal flaw that bankrupts small business owners. Fixed cost increases do not reduce your operational overhead, they eat your net income directly. Because raw material costs and employee wages remain unchanged, that $1,600 increase comes entirely out of the owner's paycheck. The owner's monthly income instantly plunges from $4,500 down to $2,900. That is a 35% drop in personal income for doing the exact same amount of work. With an 8-week deadline ticking down, the owner is forced to choose between three brutal options. Option 1 is to sign the new lease and absorb the hit. But to rebuild their lost income, they would need to increase prices across the menu by 12 to 15%. In a price-sensitive market, raising prices overnight drives customers straight to competitors, risking a collapse in daily transaction volume. Option 2 is to relocate to a cheaper building down the road. But moving a business is financially draining. Building a new space requires $30,000 to $50,000 in capital, weeks of mandatory closure, and losing up to 50% of established foot traffic. Option 3 is liquidation, closing the business, selling equipment for pennies on the dollar, and walking away with nothing to show for 4 years of sacrifice. However, the landlord has a hidden weakness that most small business owners fail to realize: vacancy risk. Landlords love to act tough, but an empty commercial building is a massive financial drain on their cash flow. Let's run the math on what happens if the tenant walks away. The landlord loses $4,000 a month in rent instantly. Finding a new tenant, running credit checks, and negotiating a lease takes an average of 6 to 9 months in the commercial sector. During those 9 months, the landlord loses $36,000 in raw rental income while still paying property taxes and building insurance out of pocket. On top of that, the landlord will likely have to pay a commercial broker commission fee of 5% on a new lease, costing them another several $1,000s. When you add up loss of rent, broker fees, and tenant concessions, a landlord loses over $40,000 by letting a reliable tenant walk away. This financial reality is your ultimate leverage point during lease negotiations. Instead of arguing emotionally, you present the numbers cold and clear. You show that a modest 10% increase preserves your operating margin while saving the landlord tens of thousands in vacancy losses. Always hire an independent commercial broker to run a formal market rent study. If surrounding comparable units are renting for less, present that data directly to the landlord in writing. Frame the negotiation not as a conflict, but as a mutual business decision to keep a stable, high-paying tenant in place. For everyone watching who is planning to open or expand a business, here is the contract playbook to ensure you never get trapped. Rule number 1, never sign a commercial lease without a renewal cap clause. This clause legally caps any future rent increase to 3 or 5% annually, completely eliminating 40% spikes. Rule number 2, negotiate a right of first refusal clause. If the landlord decides to sell the building, you get the first right to purchase it before it hits the open market. Rule number 3, amortize your build-out costs. Ensure your initial lease term is long enough to fully recoup every dollar spent on renovations before the lease expires. Rule number 4, build a dedicated relocation emergency fund starting from month 1, so you always retain the power to walk away. This breakdown is for educational and entertainment purposes only and should not be taken as formal legal, real estate, or accounting advice. If you found this this deep dive into unit economics helpful, hit the like button and subscribe to join the Profit Path community. We want to hear from you. Have you ever dealt with a predatory landlord or an unexpected rent increase? Drop your story in the comments below. Master the math behind your business, protect your margins, and we will see you in the next episode.